What if the very thing you think is keeping your finances safe is actually putting your bank account under greater scrutiny? Thousands of pensioners across Britain believe they're doing the sensible thing. They avoid carrying large amounts of cash. They spread withdrawals over several days. They try not to attract attention. On the surface, it sounds responsible. But what if that cautious habit is the exact pattern modern banking systems are trained to notice? Before we get into this, take a moment to like this video and subscribe. We cover the latest updates affecting pensions, retirement, savings, banking, and personal finance across the UK. Now let's get into it. For many retirees, money follows a predictable routine. A few £100s withdrawn for shopping, some cash for family, a little extra set aside for home repairs. Most of these transactions pass through the banking system without a second glance. Yet financial monitoring systems don't look at transactions the same way people do. They don't know you're helping a grandchild. They don't know you're paying for a boiler repair. And they certainly don't know you're trying to be careful. Instead, they look for patterns. And according to banking compliance experts, one particular pattern appears again and again whenever accounts are selected for additional review. What's surprising is that it isn't usually a huge withdrawal. It isn't a luxury purchase, and it isn't someone suddenly moving tens of thousands of pounds. It's often something far smaller. A series of modest withdrawals spread across days or weeks. Now, before anyone panics, withdrawing your own money is perfectly legal. There is nothing wrong with taking cash from your account. The issue isn't the withdrawal itself, it's the pattern. And understanding why that matters has become increasingly important in recent years. Most people assume that withdrawing £4,000 in one visit would attract more attention than taking out £1,000 four times. Common sense seems to support that idea. After all, smaller amounts appear less dramatic, less noticeable, less suspicious, but financial monitoring systems don't always interpret behavior the way ordinary people do. Instead, they are programmed to identify activity that appears unusual compared to normal account behavior. When several similar withdrawals occur close together, questions can arise. Why is the money being taken out repeatedly? Why not withdraw it all at once? Is there a specific purpose? Or is there another explanation? Again, this doesn't mean you've done anything wrong, but it does mean the pattern may attract attention that many pensioners never expected, and that's where things become interesting. Because the people most likely to create this pattern are often the people with the most innocent intentions. Take grandparents, for example. Imagine a retired couple helping a granddaughter through university. One week they provide money for rent. A week later they help with car repairs. A few days after that they contribute toward household bills. Each payment is reasonable. Each payment comes from genuine generosity. And each withdrawal viewed on its own appears completely ordinary. Yet when multiple cash withdrawals begin appearing within a short period, they can create a picture that looks very different from the reality. The bank can't see the conversation around the kitchen table. The bank can't see the family circumstances. The bank simply sees money leaving the account. And that's often where misunderstandings begin. The same thing happens with home improvements. In fact, many retirees encounter this situation every year. A roof needs repairing. The driveway requires work. A boiler suddenly fails during winter. The tradesman asks for payment in stages, a deposit today, another payment next week, a final payment once the work is complete. Perfectly normal from the homeowner's perspective. But once again, the account starts showing a series of cash withdrawals within a relatively short time frame. Nothing illegal, nothing dishonest. Yet enough to create questions if someone later reviews the activity. What makes this particularly frustrating is that many retirees choose this approach specifically because they believe it's safer. They don't want to walk around carrying thousands of pounds. They don't want to make large withdrawals. They are trying to reduce risk. Ironically, that attempt to reduce risk can sometimes create a pattern that receives more attention than a single documented transaction would have. And there is another situation that catches people completely off guard: buying a car. Many pensioners prefer owning vehicles outright rather than taking finance agreements. They save carefully for years. Eventually, they find the vehicle they want. The dealership offers a discount for immediate payment. Everything appears straightforward. But instead of arranging a single transaction, some people withdraw cash gradually over several visits. Again, the motivation is completely understandable. Large withdrawals can feel uncomfortable. Smaller withdrawals feel manageable. Yet this is exactly where misunderstanding can occur. Financial systems don't evaluate intentions. They evaluate behavior, and behavior is reduced to patterns. That's why understanding how those patterns appear is so important. The reality is that modern banking operates very differently from 20 years ago. Today's systems analyze enormous volumes of data automatically. Algorithms compare current activity against previous account behavior. They identify changes, they notice unusual movement, and they generate alerts when something appears outside the norm. Most of the time, these systems are simply doing their job. Nothing further happens. No investigation, no problem, no consequences. But understanding what attracts attention allows you to make more informed decisions about how you manage your money. And there is one situation that may be even more common than all the others combined: family celebrations, weddings, milestone birthdays, anniversaries, the moments when grandparents want to help the people they love. Many retirees prefer giving cash gifts because it feels personal, private, traditional. But spreading those gifts across several withdrawals over many weeks can once again create patterns that look very different on a bank statement than they do in real life. And that's where the biggest lesson of all begins to emerge. The issue isn't usually the amount, it's the lack of visible context. Banks can easily understand a documented transfer with a clear reference. They can see where the money went. They can see who received it. They can see the purpose. Cash removes much of that visibility. And when visibility disappears, questions sometimes follow. But here's the crucial point most people never hear. There are practical steps that can dramatically reduce the chances of your ordinary financial activity being misunderstood. Simple habits, simple records, simple planning. And some of them take less than 5 minutes. One of the biggest misconceptions among retirees is that if your money is legitimate, you have nothing to worry about. In principle, that's true, but in practice, financial reviews rarely begin because someone already knows you've done something wrong. They begin because a pattern raises questions, and once those questions are raised, the burden often falls on you to explain what happened. This is where record keeping becomes far more important than most people realize. Think about it for a moment. If somebody asked you today why you withdrew £600 3 months ago, would you remember? Perhaps. But what about a withdrawal from 6 months ago, or 8 months ago, or a series of withdrawals spread across several weeks? Most people wouldn't have a clue. Life moves on, receipts disappear, invoices get thrown away, text messages are deleted. And that's exactly why so many people struggle when they're later asked to explain activity that seemed completely ordinary at the time. The good news is that protecting yourself is usually much easier than people think. Let's go back to the example of helping family members. Many grandparents still prefer handing over cash because it feels personal. There's something satisfying about helping a grandchild face to face. But from a financial perspective, electronic transfers often create far less confusion. A simple transfer creates a destination, a record, a timestamp, and in many cases a payment reference that explains exactly what happened. Years later, the transaction can still speak for itself. Cash cannot. The same principle applies to major purchases. Whether it's a car, home improvements, furniture, or a significant family gift, documentation matters. Not because you've done anything wrong, but because memory fades and paperwork doesn't. A surprising number of financial disputes are resolved not through complicated legal arguments, but through something as simple as an invoice sitting in a drawer. One piece of paper can answer questions that would otherwise take months to resolve. That's why experienced financial advisors often repeat the same advice again and again. Keep records, keep receipts, keep invoices, and keep them together. Because when information is organized, explanations become easy. When information is missing, even innocent transactions can become difficult to reconstruct. There's another factor many retirees overlook entirely: consistency. Banking systems learn what normal activity looks like. If your account normally shows similar spending patterns month after month, sudden changes naturally attract more attention. That doesn't mean you shouldn't make large purchases. It doesn't mean you shouldn't help family. And it certainly doesn't mean you should stop using your money. It simply means that unusual activity often benefits from clear documentation. The more obvious the explanation, the easier it becomes for everyone involved. Now let's imagine a different scenario. Suppose someone receives a letter asking questions about transactions on their account. The immediate reaction is usually panic. People assume the worst. They start imagining investigations, penalties, or serious consequences. In reality, panic is often the biggest mistake. Most financial reviews begin as requests for clarification. They're asking questions. They're gathering information. They're not automatically accusing anyone of wrongdoing. Yet panic causes people to make poor decisions. Some throw away paperwork because they think it looks suspicious. Others provide confusing explanations because they're trying to remember events from months earlier. Some even contact multiple agencies before understanding what information is actually being requested. A calm response is almost always more effective. Gather the records, review the transactions, identify the purpose of the payments, and answer only the questions being asked. Simple, clear, factual. Because the stronger your records, the less room there is for confusion. This brings us to perhaps the most important lesson in this entire discussion. The issue is rarely the money itself. It's the story surrounding the money. Financial systems can see numbers, they can see dates, they can see withdrawals, but they cannot automatically see context. And context is everything. A withdrawal used to help a struggling grandchild looks very different once the full story is understood. A series of payments for emergency home repairs makes perfect sense when supported by invoices. A wedding gift becomes completely understandable when there is documentation showing where the money went. The challenge is making sure that story can be demonstrated if questions ever arise. Because once context becomes visible, many concerns disappear. That's why the most financially secure retirees aren't necessarily the wealthiest. They're often the most organized. They know where their paperwork is, they keep records, they maintain simple systems, and those habits protect them far more effectively than most people realize. As financial monitoring becomes increasingly sophisticated, clarity becomes increasingly valuable. The people who create clear records generally experience fewer problems. The people who rely entirely on memory often find themselves scrambling for answers later, and that's a lesson every pensioner, saver, and retiree can benefit from. At the end of the day, your money belongs to you. You have every right to spend it, save it, gift it, or withdraw it. The goal isn't to become fearful. The goal is to become informed. Because when you understand how modern financial systems work, you can make decisions confidently instead of guessing. And in an age where financial rules continue to evolve, that knowledge may be one of the most valuable assets you possess.